Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
On May 18th of 2010 at 12:30 in the morning, computer programmer Laszlo got the idea to order some pizza. So he posted on the Bitcoin forum, I'll pay 10,000 Bitcoins for a couple of pizzas, like maybe 2 large ones so I have something left over for the next day. I like having leftover pizza to nibble on later. You can make the pizza yourself and bring it over to my house or order it for me from a delivery place, but I'm aiming for getting food delivered to me in exchange for my Bitcoin where I don't have to order or prepare it myself, kind of like ordering a breakfast platter at a hotel or something, and they just bring you something to eat and you're happy. I like things like onions and peppers and sausage and mushrooms, tomatoes, pepperoni, etc. Just standard stuff, no weird fish topping or anything like that. I also like cheese pizzas, which may be cheaper to prepare or otherwise acquire. If you're interested, please let me know and we can work out a deal. Thanks, Laszlo. 4 days later, Laszlo reported, I happily exchanged 10,000 Bitcoin for 2 pizza. This was the first transaction in Bitcoin to ever happen. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about why conservative investors are so interested in Bitcoin. That's a fascinating story there. What do you think those Bitcoins would be worth today?
Well, 10, that's what were they worth then? 10,000 was worth $41 in 2010. Today, when Bitcoin hit the high, that it had over about $200 million. Wow, big difference, huh?
That's some good purchasing power there.
Pretty expensive pizzas.
Yeah, that's for sure.
It's
important because it was the first exchange of value on the Bitcoin network. That was the first price, right? Because there's no government, there's no entity, there's no CEO saying this is what the price of Bitcoin will be. That was the first actual price. Bitcoin had been traded back and forth between developers. But there was no value associated with it, right? There was no exchange, there was no free market. So that was the first exchange of value in Bitcoin.
How about that? That kind of be like, we can't go back, but if we could go back to some point in time and to where the first exchange, when somebody took gold and exchanged it for some kind of item or something, right? That would have been an interesting thing to see way back then compared to now. But that's what it comes down to, right, Daniel? I mean, Bitcoin is an asset class. Like gold is part of an asset class, especially metals and that kind of thing. But Bitcoin is part of a new asset class, right?
Yeah, it's a new asset class, and we get people who say, you guys are constantly talking about income, and you're talking about bonds, you're talking about preserving capital, right? Growing your money the old-fashioned way. People, we've built up our wealth. And so why are you guys talking about an 80 vol asset? Why are you guys talking about something that's, I hear gets hacked? I hear, Warren Buffett said it's rat poison. Jamie Dimon said he's going to fire anybody that trades it. Right? Why are you guys talking about something that's so crazy and spectacle?
It has a lot of opportunity to it in a lot of different ways. When I'm talking to people, the 80 vol aspect of it, where it can fluctuate and have a volatility of 80, where it can go up, but can also come down significantly. That's okay, because when I'm talking to people about that, the reason why we encourage and we look at, we talk to conservative investors about that, is it has a lot of different pieces to it, which would be, there's the inflation protection aspect about it that we'll talk about. That what's it, what is it going to be going to as time goes on? The design of it itself, it was meant for tumultuous times like we're having now. It's a way of diversifying. And the amount that we're using, generally speaking, when we're doing that for people, it's generally a small piece of their overall assets, which makes it, which makes the risk factor, brings down the risk factor totally. And so the diversification that it adds can be tremendous. So that's what I'm seeing.
Yeah, it's kind of like an insurance policy. If you do the position sizing properly, right, you pay insurance on your house, you pay your insurance policy on your vehicle, and you get nothing for that unless something happens, right? And so Bitcoin is kind of insurance policy against monetary mistake, against a political mistake, against.
Oh, come on, Daniel. There's no possibility of political mistakes. We don't need that.
Yeah. We're not fighting inflation by handing out more free money, right?
Right.
I think that's the complete opposite of what you want to do. If you have a inflation caused by too much money, give out more money. Yeah. That's for another subject.
Right. Well, when we're talking about the Bitcoin and using it, why our conservative people are interested in it, we have a paper that we'd like to give you today, and it's called Bitcoin First. And this paper was written by Fidelity Investments, and we think that would be useful to you. You're listening to Financial Strategies with Andrew and Daniel Agemy, and we're glad to have you with us today and hope you're finding this interesting. But if you like that paper, Bitcoin First, written by Fidelity, call us at 800-725-7616, 800-725-7616. Daniel, when we're doing these things and when we're using Bitcoin and having people look at that, what do you say against people like, Warren Buffett that says it's rat poison?
Well, that may be a lot more of a deeper conversation than what we want to get in today, because you can look at whenever there was a walled garden, right? Whenever there is a dominance in a particular industry, an oligarch, a mafia, someone who controls the entire market, right? Their incentive is to not embrace the new technology. So Warren Buffett has gotten rich off of banks, off of Wall Street markets, taking advantage of mispriced opportunities and things like that. Jamie Dimon runs the biggest bank in America, right? So they have incentives not to allow that. Just like the taxi, right? The taxi mafia did everything they could to lobby against Uber. And Uber ended up winning. But do you think that taxi drivers or the CEOs of the taxi companies were saying, yeah, Uber is a good thing?
Right. No.
What about oil, right? Electric vehicles were big things in the early 1920s, 1909, up until the 20s. But Standard Oil and the big oil companies had this problem. They had this annoying chemical that they couldn't get rid of it. And they were getting caught dumping it into lakes and rivers and things like that. They didn't know what to do with it. They needed the oil for lamps and, for industry, right? And they couldn't get rid of this stuff. And that chemical was called gasoline. So what do you think that they did? They encouraged combustion engines, even though people didn't like them as much because they were noisy and they were stinky and you had to go crank it. They weren't like they are now. You had to go out and crank the car in the cold.
Right.
right? To get it running instead of just getting in and driving your EV. So we know that these key holders, these gatekeepers, are not interested in the new technologies because they don't have a benefit in these new technologies.
Right. And that's a lot of times people today, investors, people who are retired, close to retirement, they built up their assets. They don't know about Bitcoin. We all hear about Bitcoin in one way or another, but there's so much that's unknown about it to the everyday Joe, shall I say, unless you've actually studied it and such. And so then it becomes something that people just don't know what to do. And they become concerned. They become maybe frightened because they just don't know where it comes into play. And that's what this show is all about today, is helping people understand it a little bit more, why you would use it, why it is usable in a conservative portfolio, and that sort of thing. That's where we're going to go with this show today. We have a book that goes along with today's show called Layered Money.
Well, before that, there's two things to it. Okay, so there's the network, the Bitcoin network. Okay. And then there's the Bitcoin asset. So the Bitcoin network is fixing the energy grid. It's providing opportunity to people who don't have bank accounts. It's providing jobs all over the world. It's providing a way to transfer money any place, anytime, not censoring it, and borderless, right? It's redeeming people's time, and it's the most secure network that's ever been created. But then and this is a very humane network. This is an amazing thing, what it's doing for people's lives, especially in developing countries. And so that we're not talking as much about today as we're talking about Bitcoin, the asset. So I want to make sure before we get into this that people realize there's two ways of looking at it. There's the network, which is doing amazing things for people's humanity, for humanity in general, for fixing the power grid, for all kinds of things like that. And then there's the asset, which is, store value and diversification and things like that. And so we're going to be talking today about the asset portion of it, not necessarily what it's doing to save humanity and to allow people to take custody of their own, essentially, time.
Right. So it's a much bigger thing. Bitcoin is a much bigger thing, and digital assets and such than just the asset piece. But that's what we're talking about, is the asset piece. And that's why I say it's its own asset class. It's a new asset class. So it's something that is available to people and has some significant potential because it's new from that. Whereas the people who have been old school investing may not profit as much from this new asset class as the people for instance, in our listening audience, right?
Right.
Excellent. So today we have a book that goes along with this to be able to educate you. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is why conservative people are interested in investing in Bitcoin. And we have this book is called Layered Money. And it's about money. We use money every day. We pull it out of our pockets, or credit cards, or whatever it is. We're using money all the time. But what is it all about? And that's what this is talking about. From gold to Bitcoin. And so we'd like to put that book in your hand today. It's called Layered Money. If you'd like that, just call us at 800-725-7616 and ask for the book, Layered Money. Okay, 800-725-7616. And we'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Daniel, I was talking to our client recently, call her Mary, and was talking to her about inflation and the impact of inflation and how she needs to, prepare for that. And how I described it. I said, Mary, think about it for a minute. When you were in high school, what was a car that you liked in high school? She said, well, Andrew, in 1966, I bought my first car, and it was a 1965 Mustang. And I paid $2,300 for that Mustang. And I said, that's great. That's great, Mary. And, the thing is, if you didn't buy that car back then and said, well, I'm going to buy one in the year 2022, I'm going to put that money in the bank and I'm going to wait until that point in time and buy a Mustang in 2022 so I can enjoy it then. Well, you would not have enough money today to buy that, because a new Mustang today cost what, $35,000 to be able to buy that car, and that's an example of consumer inflation and the price of things going up. And so that is what we're talking about today. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about why conservative investors are so interested in this new asset class, Bitcoin. Dad, I think that's probably a little mix of both, right? Monetary inflation and consumer inflation. The Federal Reserve was started to protect the dollar purchasing power. And kind of what it's sort of turned into is this club that if you're part of, right? You get to decide how much money there is. And that's why we're offering that book, is so people get the idea of where money comes from and why it is. But like, what club would you want to be a part of that somebody else makes all the rules and then it's actually taking time away from you, right? So it's stealing time for you, because we trade our time for money. So you have that money in the bank account, like you just said in your story.
Right.
And as the dollar, since the Federal Reserve has lost 98% of its purchasing power. So think about that. If you had $1.1911, it'd be like 2 cents of purchasing power today.
That's crazy. That's crazy, right?
So you work and trade your time for this thing that we call money, right?
Mm-hmm, mm-hmm.
And then you store this money. And the reason you store this money is because you hope that in the future you'll have more consumption,
mm-hmm.
right? You'll be able to do more things because it will give you more purchasing power.
Right.
And what a lot of conservative investors have missed is they've tried to protect their wealth, mm-hmm. and they've lost purchasing power because of that.
Right.
Even if you were gung ho and you invested in the S&P 500 over the last 20 years, your purchasing power hasn't increased. You look at your accounts and you're like, I've done really well, and good for you if you held through all those dips, right? Because we know a lot of people that had sold. If they didn't do it in the tech bubble, they did it in the great financial crisis, because people forget everyone thought the world was going to end, right? At least the financial world in 2008.
Yeah.
So the people who held have kept their purchasing power, but they haven't done much more than that.
Mm-hmm. Right. Because they can, even though the dollar amount has increased with what's been going on in the stock market and such, but they can't necessarily buy anymore. And one of the things I talk to people about so many times is the definition that most people who are in and close to retirement use for conservative is not losing principal. And everybody wants to make as much money as they want to make, but not losing principal is key. Well, there's not losing principal in the form of dollars. If you put $10,000 in the bank and, in 5 years from now, you have $10,000, right? I mean, your account value says 10,000, you're not making any interest on it. But then again, there's purchasing power, and you put $10,000 in the bank today, and in 5 years from now, you're not going to have, you got 10,000 in the bank, but it's not worth 10,000. Just like you said, if you had a dollar back in, what year did you say that was? 1910 or 1920?
1913.
1913, right? That today that's worth, you can buy 2 cents worth of stuff with it, with that. So, you don't have that purchasing power. And that's where very key for people to understand, those people that know the parable that Jesus told of the talents, where the one guy was given 5 talents and he ended up doubling. Another guy's given 2, he ended up doubling. Another guy was given 1 and he buried it in the ground. And he told that how wicked and lazy he was. He should at least put that in the bank where he would have got interest. Well, the bank today is worse than the ground back then, because the amount of inflation that happened back then was negligent compared to today. So you put 10,000 in the ground back then, and 5 years later, you have 10,000 worth of purchasing power. Today, you put 10,000 in the bank, you don't have 10,000 of purchasing power 5 years from now. And so why are we bringing all this up? Is because Bitcoin helps us to be able to stay up with inflation. That's what we're talking about. That's why we're talking about inflation, because Bitcoin is one of those reasons why conservative people invest in Bitcoin, because of being able to stay up with inflation. Now, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy, and we have a paper that we'd like to give to you today that goes along with this, because whether you spend principal or you put it away and your principal the spending power of the principal decreases, you're spending down principal in one way or another. And so the paper that we have is Dangers of Spending Down Principal. So again, I'm going to say that again. 2 ways of spending down principal. One is actually spending the principal that you have, which retirees tend to do. That's why they run out of money, because they spend principal. The other thing is not spending it, keeping it in the bank, and you're losing purchasing power. It's like it just disappears. It's just like vanishes into thin air, because you're not doing anything with it. So this paper, The Dangers of Spending Down Principal During Retirement, we'd love to put in your hand. You can have that by calling 800-725-7616, 800-725-7616. Daniel, and Bitcoin is helping people stay up with inflation, right? That's one of the reasons why we talk about that for conservative people. How?
Well, people have retirees, when you stop working and you're no longer collecting a paycheck, you have 2 things you have a lot of things you have to manage. But you have two things you're trying to manage. Time, right? I need my money to last all this time. And you have immediate spending needs, right? So if you invest in a time capsule, you invest in something like a S&P 500 that has shown over long periods of times it's done well.
Mm-hmm.
That puts your now at jeopardy, because you're not looking for, I hope to do well over 30 years. You're looking at, in 3 months, I need to pay this bill.
Right.
Mm-hmm. And the S&P doesn't make up for the time preference that you have to give up, right? Because we said it basically just keeps you at the inflation level.
Right.
And that's with historical numbers where the last few years have just been insane growth because of this monetary inflation, compared to actual growth in the economy, companies making more money, right? Apple's a perfect example where they've become very good at engineering returns because they can go borrow money at 0% or 1%, take that money. So now there's debt on the balance sheet that's inflating away. Take that and buy their stock back, which in turn has less shares, right? So now there's more earnings, even though if they haven't increased their earnings, now there's more earnings for each share. But they didn't create any value.
And it makes the share price go up too. So that becomes, the numbers
when you
are
buy
bigger.
back the shares, right? It makes the share price go up. But then what also happens? Well, Apple only goes up. So then people take their money and they put it into Apple, which drives it up, right?
Right.
and now all of a sudden, the S&P turns into, instead of an investment where you're buying companies that are increasing earnings, you're buying a basket of momentum.
No.
right?
Wow. That's
You're
terrible.
buying a basket of momentum
Yeah.
because as long as people are positive about that, money flows
Yeah.
into it. But when it
Yeah.
doesn't, and that's why the swings are so big, like in March of 2020, right?
Yeah.
Why the
Right.
swings were so big was because it's a basket of momentum. Now, Bitcoin is also a basket of momentum,
Mm-hmm.
right? Because it's pure emotion. But the difference is you don't have to have as big of a size. You need your entire portfolio to be in the S&P so that you'll have purchasing power in 20 years from now, right?
Right.
But what if you had another way where you could invest to provide the income you need, and then a
Right.
small portion is something that's not going to that's averaged 200% a year return since its existence. Now, I
Right.
don't think that it can sustain that forever,
Right.
but this is a new asset class that is an asymmetrical upside because the most you can lose is what you put into it. And that's why we call it insurance policy. Your
Right.
insurance premiums you pay every year. This you buy one time.
Nice.
And it doesn't matter if in 2 weeks it's down 80%,
Right.
right?
Right.
Because in 20 years, when you need that purchasing power,
Right.
this has the potential to 10, 20x, which means um, you have the best inflation head that we've seen in markets.
Yeah. Yeah. So, 10 or 20, 10x is, if you have $1,000 in Bitcoin would be $10,000, right?
Right.
With it 10x. And if it 20x, it'd be $20,000.
Right.
And, and people say, well, what's 10,000 or what's 20,000? Well, compared to the investment, it's huge. And
well, if you only have $100,000, then you're not retiring.
Right.
So,
right.
So we're talking about, if we're talking about your portfolio, right?
Right. If you have 2% of your portfolio in it and you have $1 million portfolio, now we're talking about some money.
Right.
And that's how people can stay up with inflation. And what's so great about that is, in the old days, right, people could invest in treasury bonds and make 5% on treasury bonds, take the 5%, invest it in the market. It's a very safe way. Their money was safe. They're only risking the 5%. This is a very old methodology. They're only risking the 5% that they're putting into stock market from which was the interest if they didn't need the money, or if they needed some, they could have used some of that 5% and they could invest it at 5%. And that's all we're talking about here is using it just doing a one-time kind of thing to be able to help put them in a better position, just a small piece that when everything else is invested right, it actually diversifies and makes things safer overall, right? We got that. Excellent. So you're listening to Financial Strategies with Andrew and Daniel Agemy. We need to take a break. And we're giving away a book today called Layered Money. Layered Money. We use money all the time, but we don't know a lot about money, where it comes from, how it works, and that kind of thing. That's what this book is going to educate you on. And, we're all Agemy Financial Strategies and Financial Strategies radio show is all about helping people to know what they don't know. Because if you don't even know what you don't know, how are you going to be able to make good decisions? And we want you to be able to know what you don't know. And this is one of the ways that we want to educate you. Free of charge, no obligation. Call us at 800-725-7616 to get your free book, Layered Money. 800-725-7616. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
That I was in Portugal right before the pandemic, and we were out and about, and we were trying to buy something, and I said, none of us had converted our money, and I said, don't worry, everybody takes dollars. And my friend said, spoken like a true American. And what she didn't realize is that 70 to 80% of all world trade is done in dollars. So it's not just, oh, we're Americans, we think everybody trades the dollar. It's actually true that everyone uses the dollar. And everyone wants the dollar because it's a very stable currency compared to most places. Now, maybe some places in Europe have a decent, the euro and things like that.
Right.
But people around the world want the dollar so that they can store their wealth in something that they see as a safe currency. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Daniel and Andrew Agemy. Welcome back. Today's topic is why conservative investors are so interested in Bitcoin. And we've been talking a little bit about how Bitcoin is a inflation protection and how it can be used in retirees' accounts. And we're continuing on with that. Daniel, there's a lot to go on with. There's a lot of different aspects. One of the keys that we've been talking about is using Bitcoin to as a minor position initially at this point in time, right? What, 2% give or take? Is that the ballpark?
Well, it depends it totally depends on people's
Portfolio
risk tolerance. It depends on what they're comfortable with. It depends on all that. That's just a number that we've been throwing around because I don't know what the number is for people. I know that it shouldn't be zero, right?
Right.
The number shouldn't be zero. But if it's you just want $100 worth so you can start getting comfortable with it, that's fine. So the number is different to each person, but it's around 2%, 2 to 5% where it starts actually working as that insurance policy that we talked about. Once you start getting larger than that, it starts being it starts affecting your accounts more. And if it's less than that, it doesn't really work like an insurance policy. So that number is somewhere right in that range between 2 and 5%.
Okay. All right. Good. And I like when you're using that number two, one of the things that comes to my mind, and when you relate to insurance policies, is that people's income during their working years is their greatest asset, because you take away their income and forget about the house, the cars, and all the different things that they're spending their income on. And that's where disability insurance comes into play, because if somebody gets hurt or sick and they're not able to work, well, then the disability insurance pays. And generally speaking, disability insurance is somewhere in the 2 or 3% range of but every year of their income. Right. And to take 2 or 3% of your income to insure your income is not necessarily a bad thing. Well, we're talking, 2% at one time to insure the portfolio, and also and it's also ensuring income for our clients who are dependent upon income, right? Because they're getting this money, and today this income is all well and good, but the question is what's going to be happening in the future, right?
Right. Well, we talked about it as insurance policy against political or policy mistakes, right? Policy oopsies. And
policies oopsies. Oopsies.
And the regime we're in, right? It started with no gold for you in 1933, right?
Right.
No gold for you. And it became an arrestable offense if you had gold. So the US government said, we will take your gold. And the reason they needed that was because they were backing the dollar by gold, and they needed more gold so that they could issue more dollars to keep the reserve level that they needed, right? So they did that. And then, of course, a year later, they revalued gold, right? Okay. And they took gold from $20 to $35.
Okay.
And so now they had even more reserves because they had more gold.
Right.
And the value of the gold was increased by about 40%.
Yeah.
And so now they could issue more dollars.
Right.
And then in, I think it was 35, because people were worried about banks, because banks are lending money, and it's not backed by anything. So like a bank doesn't say, well, Andrew, you deposited $100, so now I can lend $100 to Daniel. They say, Andrew, you deposited $100, so for every dollar you deposited, I can lend $100 off of that dollar because I have
Wow.
a reserve, right?
Uh-huh. Uh-huh.
And so people were talking about how good banks' reserves are and everything like that. And it's like the reserves are like 5% or something like that. So you could wipe out all reserves by a very minute bond market crash or
Yeah.
market crash, right?
Right,
But
right,
anyway,
right.
so they started the Federal Reserve, or I'm sorry, the FDIC insurance, right? So that investors felt protected having their money in the banks. And so this is how the whole monetary system that we're used to had been developed,
Right.
just slowly. And then we became king dollar. And that's where the story came from. The dollar is king, right? How did we become king dollar? Well, all the leaders of the world came together in New Hampshire, and they had a meeting called Bretton Woods, because it was Bretton Woods, New Hampshire, or the Hotel Bretton Woods in New Hampshire.
Okay.
And they decided that since the dollar was backed by gold, all currencies would be backed by the dollar. They would price their currencies to the dollar, and then the dollar was backed by gold. And that's where King Dollar came from. And that worked until 1971, when Nixon removed, and he basically said too much gold was leaving, because there was a lot of fears about um, not getting their gold back. The US had all the gold, so people were exchanging their dollars for gold, and too much gold was leaving. And so that's when we said, nope, we're not going to exchange, you know,
Yeah.
dollars for gold
Oh,
anymore.
right.
Um, and that kind of ended the gold system. And a couple of years later, the US made um, a deal with Saudi Arabia, where all oil would be priced in dollars. And that's kind of where we went into the petrodollar system. And now the dollar is kind of backed by oil, right? It's the petrodollar. People, you've heard of the petrodollar. That's what that's from, because that's kind of what it is. So people, if they want oil, they have to buy dollars so that they can buy oil. And that's changing right now based upon what's happening in Russia, in Ukraine, and Europe, and things like that.
Okay. All right. All right. So, when the idea then with the Bitcoin is that it's, we're buying it today. It can go up 10 times, 20 times in the future. It's made for crazy economic times. It's made for good economic times. It's made for bad economic times. So it's something that can work in both directions for people. When we're using it in people's portfolios, one of the things we're looking for it is that should it's a way for them to stay up in inflation, because their bottom line on their portfolio, even though they're getting the dividends, the interest that they need from their portfolios to live on, well, the bottom line on their portfolio can go up and can be used for purchasing things at the right price. I mean, even now, right? The markets are off, double digit, and it's an opportunity for purchasing, for buying positions in people's portfolio to put them in a better position, right?
Well, yes, but that whole monetary story was to talk about how it's a club that all those things have happened to give value to the dollar that you had no you cannot participate in. You had no choice over those. We're all forced upon you. Whereas Bitcoin is there's no CEO. There is no governance that decides how much gets issued.
Right.
I mean, there is, it's mathematical and it's set and it can't be changed. So you can't just say, we're going to issue more. Andrew, I think you were a good person. You can have more.
Right.
Jamie Dimon, you run the best bank in America. You get more. Warren
Right.
Buffett, you you're a nice old man, you tell some good jokes, you get more, right? It's
Right.
not like that. It's based upon mathematics. And there's only 21 million. There can never be more. And it's completely transparent. So there's no backroom deals where they decide this is going to be the reserve currency. We're going to protect Saudi Arabia. So they price in oil, right? It's mathematical. It's completely transparent, and each person gets a part of it. There's no intermediate. You get to exchange with whoever, whenever you would like to.
So we're kind of bringing down the risk because there's no one person, no group of people involved with this. There's no club that is designating more to one person than another person. There's no club or single person that's benefiting by people using or buying Bitcoin from that standpoint. So it's kind of more of a currency for the people, and for the things that are that can come into, whether it's deflation, whether it's inflation. It's kind of a might you say an all-purpose asset.
It's an asset for the people, yeah. But think about the internet. Okay, so the internet works off of Metcalfe's law, right? If there's an internet with only one person on it, what value does it have?
Right.
It doesn't have any.
Right.
Well, what if there's two people?
Well, it's more valuable, but still not very much.
Right. So the point is, the network effect of the internet is what gives it value. Now, to invest in the internet, you had to buy companies like Microsoft, Apple, Amazon, Netflix, Google, right? Facebook. These are companies. These are some of the companies, and there's others, but these are some of the companies that have really benefited from the internet. But you had to pick those proper companies, because if you pick Pex.com instead of Amazon, you failed.
Yeah.
If you picked Cisco, until 2000, you were really happy, but then it still hasn't recovered from that, right? So there's plenty of companies that failed. So you had to pick the right companies. And so there's a lot of people that have a lot of money because they picked those right companies.
Right.
Well, Bitcoin is essentially the internet. You don't have to pick winners and losers. Imagine if you could have just bought the internet, not the companies that work on the internet. Right. And it's the same network effects, but you don't have to pick. Now, things are being built on it, and you could try to pick those different things, but you don't have to. You get this opportunity to purchase it, right? Before the network is powering the entire financial system, or before central banks buy it, or before sovereign wealth funds start buying it, or before there's Wall Street products that can buy it, right?
Yeah.
These kinds of things. So that's where it gets its asymmetrical return properties from, because if it fails, which no one talks about it failing anymore. 4 years ago, people were talking about what if it fails. Now, that's not really a thing, that it fails or that it goes to zero. It might not be as big as people imagine, but no one talks about it going to zero, because it's this asset class already in of itself. But it's just, we use that go to zero because that's the worst case scenario.
Yeah. Right. That's excellent. Good. Well, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is why conservative investors are so interested in Bitcoin. We're giving away a book that we think will help you and educate you on this whole process of money and how money works and where it comes from. It's more of an easy read, being 150 pages or so, I believe. Layered Money. And you can have that book by calling 800-725-7616. 800-725-7616. Call for your free copy. No obligation. 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
If you've ever had the opportunity to rent somebody's house while you're on vacation, chances are you did that through Airbnb or something similar. But this story is about Airbnb and how they went public in December of 2020. And by the time that that they actually went public, the share price was somewhere around $68 a share. That the investment bankers and so forth that put it out for their for the offering set it at and made it worthwhile. And then what happened, however, was that before the everything transpired to where mom and pop Joe Public, so to speak, was able to buy it, the price had increased to almost $150 a share. Now, what happened? Oh, who made that money between $68 a share, $158 a share? Well, my understanding on that is how Wall Street was able to bid up the price amongst themselves. So then by the time it got to where the outsiders, not the insiders, were able to purchase it, which is most retail people, it had increased in size. Now, if you're able to buy Airbnb prior to that at $68 a share, that would have been a phenomenal deal. Well, that's the opportunity that we're presented with today, these days with Bitcoin. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about why conservative investors would be interested in Bitcoin. And Dad, I think what you're getting at there is some people may say, I have already missed the boat. It's not $100 a coin. It's not $1,000 a coin. It's trading at somewhere around $40 a coin. $40,000 a coin. I already missed the boat. But this is a tiny market cap compared to the base layer of money, or compared to the new asset class that it could be. And to compare it, it's smaller than Amazon, is smaller than Google's market cap. It's half the size of Apple's market cap. It's a tenth of gold's market cap. And, it's about $1 trillion, and US government bonds are $30 trillion. And so when you look at it in those perspectives, anything digital, right? What is there that is digital today that has a lesser value than its analog version?
Digital today that has a lesser value than its analog version. I'm not thinking of anything.
Look at mail, right? Look at mailing things compared to emails. How many more emails are sent per day?
Right.
Look at your home phone that used to hang on the wall compared to cell phones that you carry around in your pocket, right? You can look at any of these kinds of things, right? Faxes, or go back further, right? If you look at a horse carrying your mail around compared to sending an email, right? There's nothing digital today that's smaller, has smaller network effects than its analog version. Right. And so if you look at that as digital, as Bitcoin as digital gold, then that means it has a tenfold increase to catch up to gold, not even to surpass the gold market cap, right? So there's a lot of different ways to evaluate it or evaluate the price. And I think network effects is the best one, but that's another way that people can look at that, is comparing the market cap to something like gold that's difficult to transport, compared to if you're trying to get out of a war zone, right, in Ukraine, and all the ATMs, all the way to get money from your bank account are blocked or out of money, or their lines are too long. You can do a peer-to-peer exchange. Somebody that may be staying there wants your house or wants your money or wants whatever, and they can peer-to-peer exchange that value into Bitcoin. And you can carry it out either by remembering your private key or by holding a device and leave the country with that that store of your your monetary energy.
Yeah, that's that's a great opportunity we have here, because many times people will talk about, oh, I want to buy gold because of I want, with the difficulties that we have, I want gold, Andrew. Well, let's buy some gold. And then I said, that's a very difficult thing to do for several reasons. Number one, they confiscated it in 1933, like you said, Daniel, and so that could be a case. And then if you put it into if a lot of people have most of their money in IRAs, so if we put it in through an IRA in a bank, well, then the bank's closed. You're not going to be able to get your money out. So really, if you're going to buy gold from that for safety purposes, you have to buy the true gold and store it in your safe or whatnot. That becomes, there's a risk there with that, because it can be stolen or whatnot. And what you're talking about is a similar thing, except it's on maybe a hardware wallet or that thing, and that can be obviously stolen. But sometimes it's easier to take care of that than hard gold. But nevertheless, you can transport.
That can't be stolen because the keys unlock it, so the device doesn't matter.
Oh, okay.
It's not on the device; it's on the network. So if you crush that or you threw it away, as long as you have the key in your head, right?
Right.
You have the key somewhere, then you can get a new device and unlock it on that device.
Excellent. Excellent. Well, I want to, if you just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy, and today's topic is why conservative investors are so interested in Bitcoin. And we're giving away a paper today that goes along with this, called Bitcoin First by Fidelity Investments. We like to put this in your hand. We think it's a good read for you to be able to help you understand this a little bit more. And you can have that for free with no obligation by calling 800-725-7616. 800-725-7616 for your free copy of Bitcoin First. Daniel, as we're talking about this, and I'm thinking about the idea of how we started off the show with talking about the story of front running Wall Street, and this is a great opportunity that people have at this point, not only to be able to store it in their hand, like what you're saying, be able to transport it between country to country, or place to place, whatever it may be. If you're in a war zone and ATMs are shut down, you still have access. But also the aspect that once Wall Street starts offering Wall Street products for it, I believe it's going to become available in 401k plans and on various mutual fund platforms and so forth and so on, where the supply or the demand is going to be far greater than the supply at that point, which will drive the price up, besides the facts that we've already spoken about in today's show, and the aspect that there's a limited number available that will drive that up as well. And that's a great thing, to be able to forerun Wall Street or Wall Street products on something like that. Do you agree with that?
Well, there is not been an asset class that the regular people get to invest in before the elites, right? And this is the first asset class that this has ever happened, because the barriers to entry were low enough that regular people could get it. So everyone had equal opportunity. Now, lots of people heard about it, myself included, right? And thought it was a joke. It was like Beanie Babies. It was like the Tula Bubbles, right? We've heard all these kinds of things. And then some people keep thinking that, and they don't change their paradigms. And some people do the work, right? It takes at least 1,000 hours to really understand it. And then once you understand it, then you say, oh, wow, this is like the internet. This is going to change the world, right? The people who were saying, well, the internet is just a fad. Were those people right? We do everything online now. Everything, right? If the internet went down, there'd be mass chaos, because nothing would work. No one would know how to do anything, right? It completely changed. It wasn't just a fad. So you, before you say something like it doesn't work, or it's a scam, or it's Beanie Babies or whatever, you have to do the 1,000 hours of work. And then you can decide if you want to say that or not, right? And that's another reason why the Jamie Dimons, although JP Morgan is now offering research in the crypto space, but and Warren Buffett, they haven't done that work.
Yeah.
And they don't need to, because they're rich enough.
Right. Exactly. So, we're running out of time fast today. And, in regard to why conservative investors are interested in Bitcoin, we talked about a lot of different things, inflation, how it's inflation hedge, and it's a way that they can diversify and be able to get more bang for their buck, and actually help lower their risk with the diversification, even with the volatility. What final things, Daniel, would you like to try to get across to our listening audience today as we close up?
Well, the further Winston Churchill said, the further we look back, the further ahead we can see. And I think that is so true. And that's basically learning from history. And so we can look back and we can see that fiat currencies, right, have 100% failure rate. And so we're not suggesting anyone get out of the monetary system, right? That the doomsdayers and all that, that's not what we're suggesting. But if you can participate in something that will benefit from this thing that we know is going to happen over time and has been happening, like we said, you've lost 98% of purchasing power since the Federal Reserve was started, right?
Right.
That is something that you cannot live without. And so adding this or learning about this so you can decide if this is something that is needed in your portfolio, right?
Mm-hmm.
Is something that everyone, no matter what phase of life is, needs to consider and look into. Secondarily, when we're talking about balancing out a portfolio, when we're trying to invest in an everything bubble, right?
Okay.
Indices are all at their all-time peaks. I mean, they're not at their all-time highs. They're down a little bit from that, but valuations, when I say
still high.
When you look at valuations, debt is at that, right? Everything's a bubble. Real estate, you can't even go buy a house, right? You live in Denver, you can't buy the average house is $600,000, right? Everything is so overpriced. So you see something like this where you have such an asymmetrical return, where it's undervalued for what it will be able to do and what it already is doing at any value, at any metrics you use to evaluate it. You can add that into a portfolio that's already diversified and creating stability, right? Everything we do here is we talking about providing stability in people's portfolios so that they don't have the stomach-wrenching roller coaster rides in their retirements, while creating the income that they need to sustain the lifestyle that they want to have, right? And then you put a turbo inside there that gives you a call option on the future payment system, as well as the best inflation hedge we've ever seen. That's a pretty cool combination for building that stability and protecting people in an uncertain world. And that's why so many conservative people are actually interested in adding a piece of this into their portfolio.
If it's stress-free, it's for me. That's one of our big goals, is be able to help our clients become stress-free, help our listeners become stress-free in their retirement, because stress is not a good thing. So listen, if you're listening to Financial Strategies with Andrew and Daniel Agemy, we're glad that you were with us today. We have a book that can help you understand these things that Daniel's talking about, that learning 1,000 hours put into what we hope you don't have to put in 1,000 hours to get some benefit, at least from this show. And this book is called Layered Money. It's yours for free, no obligation. Call us at 800-725-7616 for your free book. And we are glad to get that out to you for no charge. So until next time, you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And you too can have a stress-free retirement.